Welcome to our in-depth tutorial on the unit of account, a fundamental concept in finance and economics. First, let's define what we mean by unit of account. In essence, it's a standard numerical monetary unit of measure that allows people to compare the value of goods, services, assets, and liabilities. Let's take a simple example. Imagine you are at a farmer's market. There are two stalls, one selling apples and the other selling oranges. One apple costs $1 and one orange costs $1.50. The dollar here acts as the unit of account, which allows you to compare the value of apples and oranges easily. The unit of account simplifies transactions because it creates a common standard. Without a unit of account, commercial transactions would be incredibly complicated, as every good or service would need to be priced in terms of every other good or service. Let's delve deeper into its importance using a historical perspective. Think about the barter system. Goods and services were directly exchanged. Here it gets tricky. How do you determine how many apples are worth one cow? This is where the unit of account revolutionized trade and economy. Another key example comes from different countries. Before the euro, European countries had their own currencies. Trading across borders meant dealing with exchange rates and price comparisons, simplifying immensely once prices could be labeled in euros. Let's look at some real-world data on the purchasing power of the dollar over the past century. As you can see from the chart, the unit of account has allowed us to track inflation and deflation trends, which are crucial in making informed financial decisions. Now, let's interact. What would you do if the unit of account fluctuated frequently? Suppose you have $100 saved. If the unit of account were not stable, would you feel confident in the value of your savings? How would that impact your decision-making? Another interesting question: how does cryptocurrency fit into this concept? Bitcoin, for example, is often discussed as a potential future unit of account. Given its volatility, do you think it serves effectively in this role? Now, let's switch gears to explore the limitations of the unit of account. While it standardizes monetary measurements, it doesn't solve problems around currency stability or exchange rate fluctuations. Think about hyperinflation scenarios such as the ones experienced in Zimbabwe. When the unit of account itself becomes unstable, it loses its efficacy. This substantially disrupts the economy and individual financial planning. To illustrate this further, here's a comparison of inflation rates across various countries over the last decade. Look at how wildly these figures diverge. Such statistics underline the importance of stable units of account. Units of account also come into play significantly in international finance. Exchange rates are calculated using it, affecting everything from import-export pricing, international investments, to evaluating multinational financial statements. For instance, when a U.S. company imports goods from Europe, the payable needs to be converted from euros to dollars. This conversion relies on the unit of account to establish comparable values for accurate financial reporting. To conclude, the unit of account is far more than just a theoretical concept. It's a cornerstone of economic stability and a facilitator of trade and financial planning. Without it, modern economies would be far less efficient and more chaotic. Thank you for watching our tutorial on the unit of account. We hope you found this information valuable. Don't forget to like, subscribe, and comment below with your thoughts and questions.